Hello, Highland Group community. It's Cece here, and today we're talking all about taxes. We have a special guest, May Wong, who's a certified public accountant here locally in Orlando, and she's going to help us answer the top questions that home sellers have about taxes. Now, as a homeowner, the biggest question you have is what will I net from the sale of my home, right? How much will I actually get to keep? Well, a big part of that is taxes. The most common questions that I encounter when I speak to homeowners is, do I have to pay taxes? If I do, how much? How do I report it on my tax return? And if I don't have to pay taxes, do I still have to report it? And so we're going to tackle those questions today with May. May, thank you first for being here and talking with us and sharing with us your experience and your expertise. Could you first share with us a little bit more about you and your experience?
Sure. Hi, everyone. My name is May Wong. I am partner at MJ Tax and Consulting here in Orlando, Florida. My twin sister and I actually started this firm in 2014, excuse me. I received my bachelor's and master's from the University of Central Florida in accounting and got my CPA license back in 2009. I started my career with one of the big four firms as a staff auditor at Ernst & Young. I worked there for 4 years. And then I went over to Verizon's accounting department for 3 years. During that time, my sister and I actually worked two jobs where we started this firm on the side. And then in 2013, it just kind of grew and we couldn't juggle both workloads anymore. And we kind of took the leap of faith and started this full time.
Mm-hmm.
So here we are 2.5 years later. Our firm has been growing, and we specialize in business and personal federal income taxes, bookkeeping, and also we do a lot of accounting system development where we help new business owners set up their accounting systems.
The audio cut out for just a second while you
Okay,
said the last thing, but you said that you also specialize in helping businesses start up. Is that what you
correct.
said?
That
Okay,
is
great. Well, May is actually my personal
personal
CPA
CPA.
for our businesses. And so, what I appreciate about you, May, is that you're so thorough and you're so patient with all of my questions, and you're so quick in response too. So, thank you so much for that. And I did hear that you mentioned that you started your firm with your twin sister. It's your identical twin sister,
No,
right?
actually fraternal. We're
Oh,
fraternal,
really?
even
You
though
guys
we
do look
very
a lot alike, though.
yes,
And she's also a CPA.
yes.
So what is that like? Just twin careers and starting your own business together and being in business together and being twins. What is that like?
It's awesome. Even though we're fraternal, we think alike. We work so well together. And one thing that's great is that she started her career in the tax side, while I started in the audit, more the company bookkeeping. And so we work really well together. Where if I have any tax questions, I can punt it to her, and then if she has any questions about, accrual accounting and gap and all the good stuff about regular company books, then she can ask me. So we make a great team.
Yeah,
And it's been
that's
fun.
great.
Yeah.
That's great. And just a quick side note too, I was thinking about because your name is listed as May Wong. I know that's you're married with a married name too, but
Hmm.
in case people are wondering, we're not related because my name is Wong too, right?
Yes.
we're, we're just friends. Wong is like the Chinese version of the Smiths, so
Yes. That's
there's a bunch of Wongs out there. And so let's get back to taxes. I know in the tax world, there's just so much to know, right? There's
yes.
just because even with you, there's so much schooling, being certified as a public accountant, you have to know all the different ranges of taxes. And particularly in real estate, it even depends on the type of property, the
Yep.
type of ownership you have,
Yep.
um, how you sell it. And there's so much to know. But today we're just going to focus on a homeowner of residential properties and also an investor of residential. So just focusing on residential homes, and then we'll talk about those two types of owners. The first we'll kind of get into first is just owning your primary home and selling the home that you live in, and the primary residence. So the big question is, do you have to pay taxes?
So that depends. Oh, excuse me. That depends. It so there's two rules that you have to meet. And the first rule is that you have to live in the home for 2 years out of the 5 consecutive years. And then if the profits are less than 250K profits, then you do not have to pay the taxes, the capital gains on that profit. Now, if you are over the 250K in profit, then unfortunately you will have to report that as a capital gain. And depending on your tax bracket, then the tax rate does change. So that's general rule. But most of the time, what we see is that homeowners with their primary residence, they don't have to pay anything.
Okay, they usually don't have to pay if it's under that $250,000 profit
Correct.
limit.
Correct.
So you have to have owned your home for 2 years out of the last 5 years.
Correct.
So this year is 2019. 5 years ago, 2014.
Correct.
So from 2014 to now, if you've lived in the home for 2 years, is it 2 consecutive years?
No, it's kind of interesting. Let's just say you lived in it the very first year, all 12 months, and then you decide you wanted to rent it out for the next 3 years. And then the fifth year you live in it for 12 months, that's 2 years. You met the criteria.
Gotcha.
So it's interesting. You can rent it out in between. You can live in it maybe year 2, year 4. So
as long as it's 2 full years of
correct.
Of it as your primary residence.
Correct.
Okay. And then when you say no more than 250,000 of profit, what number, after all the calculations, the numbers, is the profit that is used to calculate it? Does that make sense, the question?
Yeah, so we'll make it really simple. It can get really complicated, especially if you kind of use the property as an investment property, which I know we will talk about later. But if you do rent it out during a certain period of time, sometimes depending on your accountant, they may take depreciation. So let's go let's start from the beginning. So let's just say you bought the home for 200K. Okay? That's the cost basis, right?
One second. The audio is going out just a little bit.
Okay.
Could you start over your example again?
Yep. So if you bought a home for 200K, that's your cost basis. Let's just make it very simple. You didn't have any home renovations. You didn't take depreciation because you didn't rent it out and anything like that. Also, keep in mind that closing costs, those costs do get added into it. So let's just say you incurred 10 grand of closing costs, loan costs. So you add that back, and so it's 210K. And then now, fast forward 3 years, you want to sell it. So you sell it for, let's just say 300K. And so that means that you made a profit of 90K. So 90K is below the 250K limit. So that means that you don't have to pay any capital gains on that.
Okay.
Yep.
Okay.
So that's very simple math, but I will definitely consult your CPA or accountant to determine the true cost. So that way you can maximize as much as possible the benefits, right? Not paying so much. People may forget that there are certain costs that can be deducted from the total, I guess, the net amount. So.
Right. Okay. Yeah. So better to definitely talk to your CPA or accountant to figure out the exact amounts.
Correct.
But you're saying that if your home, if it was the 200,000 plus 10,000 for closing costs, and then you sell it, you're saying if you sell it for 300,000, in your example, then the net in that simple example would be 90,000 would be the net profit. Okay.
Correct.
Okay. Correct. Great. Yep. Thank you. That's very helpful. Yep. And then how do you report it on the tax return?
So that one's interesting. So usually nobody really gets a formal form, but there are some, I guess, title companies, depending on who you work with, maybe agents, they can issue a 1099 to you for the sale of that property. If you do get one, you have to report it regardless. But keep in mind, if you meet all the criteria under the 250K, which I forgot to mention, that's only for single. If you're married, that limit goes all the way up to 500K.
Gotcha.
So, yeah, and so as long as you just report that, all the calculations run through, you're not going to pay anything if it's below the limit. But that's the key thing. But if you don't get anything and you do go over the limit, it is your responsibility to report that on your tax
Mhm.
return. It's
If you don't get the 1099 and you do profit over 250K or 500K if you're married, it's the seller's responsibility to report
correct.
it and file that with okay.
It
And
would be
if
the
they
buyer's responsibility. Oh, excuse me. Yeah, the seller.
the
The seller.
seller, right.
Yeah.
Yeah, the seller's responsible. If you didn't receive the document like a 1099
Mm-hmm.
and you did not profit over the 250 or the 500K, um, then essentially you don't do anything.
No, there's nothing.
There's nothing really to give to
No,
when you're filing your tax return or anything like that.
correct. There's nothing
Okay.
you need to do. Yeah.
Just if you do get the 1099 for some reason, even if you profited less than 250 or 500K, then you just hand that in
Correct.
along with your tax returns.
Correct.
But if not, then you just don't do anything. Okay.
That is correct. Yep.
Okay. Thank
Exactly. Yeah.
you.
One of those because the 1099s are submitted to the IRS. They have it in their system that okay, this person has a 1099 for a home sale, and I better see that on their tax return. And so they do a lot of checks. They have a lot of computer checks to match up. So it's better to just report it even if you don't know
To report it if you don't owe anything if you had gotten the
it. Correct.
1099 filed. Okay.
That is correct.
Gotcha.
Yep.
All
Mm-hmm.
right.
Yep.
Thank you. So now we'll move on to an investor who owns a residential property that maybe it's their rental home that they rent out and now they're thinking about selling it. How does
Yep.
that affect the taxes when they sell the rental home?
So it's the same thing as kind of like the primary, where if you are switching back and forth, right? You lived at the primary and then you decided to flip it into a rental home and you go into your second home. You have a vacation home and you live there. Then that primary residence, it's you have to meet the criteria, right? If you don't meet that criteria that we spoke earlier about the 2 years out of the 5 years that you have to live in, and if it's under, over the 250 or the 500K mark, then you have to pay the taxes. Now, if you don't, in general, if this is just a flat out investment property, you don't live in it, you rent it out the whole time, unfortunately, all the gains or even losses will have to be reported on your tax return.
Hmm.
Depending on how it's structured, it can be on the business tax return or your personal tax return.
Hmm.
That's general rule of thumb. Usually, investment property sales are fully that needs to be reported.
Right. And the capital gains is the profit that's made when you sell your house after your accountant has calculated all the exact numbers.
Correct.
Okay.
Correct. I mean, and also some people do face a loss, right? And so here's the tricky thing about lot of these losses is that as if it's a primary resident, a personal residence, and you have a loss, unfortunately you can't take it. Okay, so
I'm
that's
sorry, the audio cut out for a second.
yeah. So if it's a primary residence, and you actually incurred a loss on the sale, you can't take that loss on your tax return. It's one of those that you just have to swallow. Now, if it's
Okay.
investment property and it's in the business or trade, um, then there's a potential that you can take that loss on your tax return. So there's a lot of rules. I don't want to go way too deep into it. It's very complicated,
Hmm.
but definitely consult your CPA or accountant about that and see how you can minimize, how you can maximize taking all that capital loss onto your.
Right.
Right. So
Yeah, how to take advantage, maximize that on your taxes if you're the investor
correct,
that is dealing with the rental property strictly.
correct. Yep.
Okay,
Hmm.
great. Well, any last minute must know about taxes,
Let,
final big tips?
let's see. I think on one we've always gotten questions about vacation homes, and I think this one is a good one. So a lot of people do own a second home, a vacation home, and unfortunately, it's if you sell that vacation home and you don't meet the criteria, the 2 out of the 5 years, then you have to report that gain.
You have to report the gain. Yeah.
Yeah, you do have to. Yep, exactly. And so, but it's funny. It's unfortunate. Some people don't consistently issue those 1099s properly. And so it is up to the taxpayer, seller to be self-reported. So
Oh, up to, sorry, cut out for just a second. It's up to the taxpayer to self-report it.
to self-report it, correct?
Okay.
Yeah.
Hmm.
So it's your responsibility. So hopefully, you don't get audited and they won't find out, right? But that's the
Right.
thing is, as a self-reporting it with a self-reporting system, you're gonna have to, just make sure.
Right. So you mean the self-reporting if they haven't really lived there the 2 years out of the five? Is that? Yeah.
Yeah, because a lot of the
Yeah.
a lot of the transactions I've seen with my clients is that they do tell me that they have some properties sold, but they never get a 1099. So it's one of those that they had to tell me, as their CPA, to how much the gain was, right? Or calculate the cost and the purchase price and all that good stuff and figure out the net profit, and help them
Hmm.
report. So,
And just the last question too, just going back to the homeowner who has met the criteria of 2 to 5 years,
mhm,
and they don't make the gain, they don't have a capital gain of greater than the one, I'm sorry, the 250 and the 500K,
mhm,
and they tell their accountant that, yeah, they sold their home. Um, there's no negative effect to that. They still don't have to pay taxes because they
exactly.
met that. Right. So
Correct.
even if you tell that to your accountant, what does the accountant do with that information if they don't need to file?
Then it's okay. We just kind of file in our notes that this person sold their home, but if no 1099 was received and you guys meet the criteria, there's nothing we need to report
Okay.
on tax return. Yeah.
Yeah.
So
Okay. That's good to know.
yeah. Oh, and also there's one thing I'm sure a lot of uh, sellers do hear about, this 1031 like kind exchange. That's
Hmm.
something that floats around in the real estate business. So that's another way to defer taxes.
Okay.
Is that when you want to sell a property, you can find a like kind property to do an exchange. So basically, all the proceeds get swept into another investment property or primary residence or whatever property. So, but the key thing is, you need to plan this earlier. You can't just go, okay, let me go sell my home, my property now, and then file for a 1031. No, no, you have to do it beforehand. There's a process, so make sure, there are specialists out there just that take care of that 1031, like kind of exchange.
Mm.
So definitely reach out to them before you even decide to sell a property.
Right. Reach out to the accountant that specializes in the 1031 exchanges.
Correct. Correct.
And how much time do you, just in general, beforehand to get started in that process before
Um,
you're
I
thinking about
mean,
selling? Are we saying like
if
6 months, 3 months, a year? What?
I think as soon as possible, when you know that you want to sell your property,
Okay.
reach out. If you want to defer the taxes because you know that you're gonna get a huge capital gain. Let's just say you own this property since 1950 and you sell it now and it's appraised over 100%, then you're like, oh crap, I'm gonna get a hit on the capital gain. So definitely, uh, then start planning that and
Hmm.
see, what you can do. But it's a process. You have to close within, there's 180 um, day period to from the day that you sell to
Hmm.
the day that you actually purchase a new property. So
Gotcha. Okay.
it's a
All right.
pretty
Well, yeah, that sounds good. Well, thank you
Mhm.
so much for sharing with us your expertise on this today. And if our Highland Group community, if they have more questions, is it okay that they contact you directly?
Of course,
Okay,
of
I'll
course.
leave your information in the description
Okay,
of box below. And then if there's anything I could help, feel free to email our team as well. It's contact us at highlandgroupfl.com. And yeah, thank you, May, for joining us today.
thank
If
you
you
for
guys
having
have a Thank you. And also, one more thing, if you have additional questions about real estate or about taxes, like I said, feel free to contact me directly. Leave the comments below as well. You can do that. And we'll see you in the next video. Thank you.
Thank you.